All right. Hello, everyone. Thank you for checking in. At times, there's really nothing important going on in the market, but sometimes there's a lot of things that are important that are going on. And there seems to be some pretty interesting stuff going on now. So, the first thing I want to talk about is this whole recession story. Now, everyone's kind of saying, oh, well, we're out in recession, all the pundits were wrong, blah, blah. And the pundits usually are wrong. So, I have no issue with that. But right now, the yield curve is as inverted as it's ever been, at least going back to, as far as this chart goes back to 1988. That's where they added this blue line. Let me just kind of fix this here. I think there's a better way to look at it. So, oh yeah, okay. So here we go. So this shows you. So since 1955, there's been 9 recessions, and an inverted yield curve happened right before 8 of them. So right now, the yield curve is more inverted than it has been at any time since 1993. All right, going back 40 some odd years. This is when I graduated college, actually in 92. And now I'm taking my daughters to visit colleges. Well, actually, they each got in, but I'm going to the whatever, to just bring it up there to visit and get their classes. But anyway, talk about surreal, but that's, I guess, for another channel. So the yield curve is very, 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 very inverted. Now, what is an inverted yield curve? Well, in the normal way things work, if you have a bond, the farther out the maturity, the higher the yield should be. This completely makes sense with capital markets theory and even common sense, which sometimes they don't go inside. But if you're going to hold the bond for 10 years, there's 10 years where something may go wrong and the bond defaults. So they're going to have to pay a higher return or a higher dividend than a bond that expires in, say, 2 years, because in 2 years there's less that can go wrong. In financial markets, you need to be compensated for the risk that you take. So on this chart here, again, going back to 93, the red line is the 10-year yield of U.S. Treasuries, and the blue line is the 2-year yield. Now, notice the vast majority of the time, like 98%, the red line, the 10-year yield, is higher than the 2-year yield. That's how things should be. Now, in a normal operating market. Now, look at this. We've gotten to extremes of inversion. The 2-year yield is now paying a full percentage point, which, if you do it in percentages, that's like 25% more than the 10-year bond is paying. This is the most extreme the yield curve has been. Why is this important? Well, like I said before, inverted yield curves have preceded 8 of the 9 recessions that have occurred since 1955. Why does a yield curve invert? Well, let's just think about this. Oh, you know what? I got a good idea. I'm going to bring up my calculator. Calculator. Okay, so think about this. If you buy a bond that costs you $100, I don't even know why I'm doing this, and it pays a $10 dividend every year, it's 10%. Pretty darn simple, okay? You pay $100 for the bond, you get a $10 return over the year, that's 10%. Now, let's just say the bond goes down to 90. And if people are selling the bonds, bond prices move. The thing to remember here is that bond prices move, but the yields don't, assuming the bond doesn't default. Now, let's say that same bond goes to 90. It's going to still pay $10 a year, but whoever buys it at 90 is going to get a 11% return. Let's say the price of the bond goes up to 110. Whoever buys it at 110 is going to get a $10 annual dividend. Okay, so if we do, sorry about that. So if we divide 10 by 110, that person will get, all right, come on. Let me figure, oh, wait. All right, 10 divided by 110 equals, okay, so the person who buys it at 110 is going to get a 9% yield. So you get $10. If you pay 100, you get a 10% yield. If you pay 110, you get a 9% yield. If you pay 90, you get a 11% yield. Now, what happens here with the inverted yield curve is that for some reason, the bondholders or the bond market are really, really, really selling the short-term bonds, the 2-year bonds aggressively. Okay. This pushes the price of the bond down and it pushes the yield higher. They're also very aggressively buying the longer term bonds. And this could be interpreted as in a couple different ways. In the long run, things will be okay, or it's money that's not going into the stock market. So when you get aggressive selling of short term bonds, aggressive buying of long term bonds, that inverts the yield curve. The bond market is telling us, we got to get out. Things ain't looking too cool. Maybe things come back in 10 years. That's why they're longer term buyers of bonds, or maybe it'll get back, but it'll be less. But in the meantime, I'm going into long term bonds. I'm not going into the market. So that into the equities market. So that's what the inverted yield curve is. Now, this isn't just for, discussion's sake. I want you to look at something here. Let's take a look at the S&P. I'm going to just bring up the S&P 500 at the last time that these yield curves were inverted. Sorry, XPX is the actual S&P 500. So we're going to take a stroll down memory lane here. We're going to go back to March of 2000. That was the height of the internet bubble. And we're right here. So that March of 2000 was right here. So when the yield curve inverted that time, we had a huge sell-off afterwards. And that was the dot-com bubble recession. The next time we inverted in 2006 in December. And actually, this is a little misleading. December was when it first inverted, but it was still inverted by May of 7. All right, now let's look at 2007 in May. That's right here. So right before we have this other big sell-off. So if history is a guide, the inverted yield curve is telling us that we are going to have a big sell-off. And if it's all relative in terms of percentages, maybe the fact that the yield curve is so inverted, way more than it was at these other times, maybe we get a bigger sell-off. And the S&P was down about 50%. The NASDAQ was down like 90%. And I remember that very well because that's when I first came into the trading world. All right, so let's look at SPY, and I won't keep you much longer, but I did want to address that. There's also something else I want to address, but I'll get to that in a few. All right, so we look at the S&P 500 ETF. This tracks the S&P 500. For retail traders, you really can't trade the index directly. In the institutional world, you can trade futures on it, but it's half a, what's the expression? 6 to 1, half a dozen to another. Now, the S&P has kind of stalled out over the last 3 days. Where did it stall out? Right around 443. Why is there resistance here? Because there was resistance here. What is resistance? When a market is moving higher, it's because there's not enough supply or sellers to fill all the demand or buy orders. So the buyers are forced to pay higher prices. This forces an uptrend. They have to pay a premium. They can't buy all they want, right? Like what we would say in trading lingo is right in line. In line just means somewhere around the last price. When we get to a resistance level, the tide turns. Now think about this. There are investors that are watching this that want to sell, and they notice the price stops moving higher. So they make this assumption, which is correct, that there's other sellers coming into the market. That's why all the buy orders could get filled. Some of these investors start to get worried that they're not going to be able to sell their stocks because if there's someone else who's willing to sell at a lower price, that's who the buyers are going to go to. So we get this snowball effect. I was going to say Santa Claus, but we get this snowball effect of sellers undercutting each other, and this forces a downtrend. Okay. Now, why do we have resistance here? Well, there's people who bought up here who regret their decision to do so, and they still hold the shares. They tell themselves, I made a mistake. I want to get out, but I'm going to get out at break even if I can. So when the price gets back to their buying level, if there's enough of these remorseful buyers placing sell orders, the level that was resistance becomes resistance again. And this is something we call market memory. An important price level can retain its importance for a long time. And the chart I like to show people on this is CVS. I mean, if your neighborhood is like my neighborhood, or I should say city, you got a CVS on pretty much every freaking corner. Pretty amazing. But they do provide a service because they pretty much sell anything. I mean, geez, I went over to CVS the other day to buy duct tape. My daughter got a new guinea pig. We adopted a new guinea pig from a rescue. And yeah, I had to kind of assemble its cage. And, it says on the side of the box, it's like, oh, easy assembly. It's like easy assembly, my you know what. I mean, gosh, I just spent like 3 hours on it trying to put all the screws in. And finally, I was like, you know what? I'm just going to go get duct tape and do this the old fashioned way. But here's an example of market memory. This 111 level for CVS was important back in 2015, became important last year. 83 was an important resistance level for 2.5 years from January of 17 to November of 18. So forth and so on. 52 support for here. A big, important top thing you should think about when you're trying to trade for a profit is what price levels are important. In the institutional world where I spent more than 2 decades, I will tell you this with 100% certainty. Institutional traders aren't thinking about things like Gann theory and Elliott wave and Fibonacci and harmonic charts or all this other mumbo jumbo. I mean, you want science fiction? I recommend you watch the Twilight Zone. It was on this weekend, marathon. Always check it out for a little while. There's always some episodes I never saw before. But the traders pay attention to psychology. Why is resistance? Resistance again. Psychology, buyer's remorse. Same thing down here, okay? It's psychology. When you look at a chart, this is a graphical illustration of psychology. Now, the most important thing in the market, I think, to watch is what goes on in the financial sector. Different things drive the market at different times. I think right now, different sectors drive the market at different times. There's 11 sectors, and everyone focuses on tech because of AI, but this is going to be real important to watch here. Again, notice important price levels. If we go back to here, support became resistance. Why would this happen? Well, people bought here, price goes lower. They tell themselves, I made a mistake. I want to get out of break even if it comes back. Remorseful buyers placing sell orders at the level they bought at can convert the level from support into resistance. Now we have resistance become support. What's going on here? People sell, price goes higher. They tell themselves they made a mistake. They say, I'm going to buy my shares back if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders, the resistance can convert into support. We see that here, right? Well, actually, support becomes resistance. Now, if this resistance turns into support, and it has been over the last day or two, this could set the stage for another move higher. So make sure you check back in. I don't want to give you too much, but I just wanted to cover the inverted yield curve, and I just wanted to convey my thought that sometimes different things are in the driver's seat. And, for the last month up until about a week ago, the prior month was all about tech. I think now it's shifting to all about financials. And one thing I want to address before I go is this. MULN Automotive stock rockets on record volume, blah, 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 vows to take action against short naked sellers. This is so typical, and I have seen this in my career so many times. And it's stock goes down. The management doesn't want to accept the fact that they suck and they're losing tons of money. And they're like, oh, it's the short sellers. It's the short sellers. It's the naked short sellers. As someone who was in the institutional world for 20, 25 years, and who is actually a market maker for 2 years, I can tell you this. If I wanted to naked short sell something, I'm not smart enough to figure out how that could have happened. When you sell a stock or buy a stock, you get all these parties involved. You got who's ever buying it, who's ever selling it. You got the broker, and then the buyer and the seller each have custodian banks. So all 5 of these people would need to be in on it. And it's just sour grapes. This company is probably down because let's see how much money they're losing. One of the other things we do over here at Stock Market Jobber is it's not just purely technicals. Oh my gosh, look at this. Jeez. Yeah, you'd be mad too if you were the management and you owned, I got 1 million shares. I got 10 million bucks in the bank. Oh, now it's down to 17 cents. It's like, what is that? I got $17,000. So of course they're angry. But one of the things we can do, look at that. They're losing 31. Is that dollars? All right. So anyway, before I get going, you can just type in the symbol, and on pretty much any company, and then type in IR for investor relations. And that should bring you to the investor relations page. So this is it here. Now we can go to the, let's see here, our story, investor relations. We want to go to the last earnings release. Oh, look at this. They hired a lawyer. Oh my God, this is going to be so fun to watch. Why don't they have the earnings readily available here? It's a little bizarre. Oh, gee, could it be that they don't want people to see what their earnings are? All right, I got an idea. So let's just go to a Yahoo Finance, believe it or not, is actually pretty good. We're going to go to Yahoo Horoscope. I was looking at my horoscope before. I'm a Virgo. But we're actually going to go to Finance. Oh, this is going to be fun following this MULN over the next couple of days. Okay, MULN. Now we're going to go to the financials. Every quarter, a company typically releases what we call an income statement, a balance sheet, and a cash flow. They're in their earnings. Now, let's just kind of go down here. Now, these are their earnings. Wow. This is incredible, frankly. I guess it's because the stock is so low price. I don't get this. This is crazy. All right. So this is somewhat out of date, or it could be that they are on a different reporting schedule. But look at this. This company is not down because of naked short sellers. This company is down because in September of 20, they lost $30 million. September of 21, the quarter leading up to that, they lost $44 million. The last quarter, they lost $740 million. They lost 70 cents, $70. It's not even cents, $70 a share. So I'm sorry if you own this thing, but I just wanted to point out this is something you see a lot on Wall Street. You get these stocks that just get crushed because the management does such a bad job. And then the management, instead of coming out and accepting responsibility, they're like, oh, it's the short sellers. Oh, it's the short sellers. Good traders, if they make a mistake, they ask themselves, what did they do wrong? Bad traders, and these guys aren't traders, but it's the same principle. Blame someone else if they lose money. All right, everybody, thank you so much for checking in, and I will talk to you soon. Make sure you check back tomorrow and check back, too, for our morning 8 o'clock call. And I will talk to you then. Thanks, everyone.